Today, a right royal pickle. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the markets continued on their volatile way with an up day on Tuesday, supported by a chip-led rally in tech, and as better than expected retail sales data pointed to a strong consumer, offsetting their gloom, of course, as indicated by the recent Michigan confidence data. But spending while they can, and by the way, in an inflation-ridden economy, buy today or buy for more tomorrow. Plus, of course, inflation is listed in the cost of everything, so we would expect to see retail gains. The Dow Jones Industrial Average gained 1.3%, the S&P 500 rose 2%, and the Nasdaq rallied 2.7%. Tech climbed by more than 2%, led by semiconductors as AMD and Nvidia racked up gains. Advanced micro devices jumped 8% after Piper Sandler upgraded the chip maker to overweight from neutral following the recent pullback. And big tech was also in the ascendancy, struggling off a fresh climb higher in treasury yields following signs of that strength in consumer sales. The Commerce Department said that retail sales actually rose 0.9% last month, in line with economists' forecasts. The Retail Sales Control Group, which is filtered into US GDP, rose 1%, which was well above expectations for a 0.5% rise. They grew at a solid pace in April, reflecting broad-based gains, and it does suggest that demand for merchandise remains resilient despite rampant inflation. So the value of overall retail purchases increased 0.9% after an upwardly revised 1.4% gain in March. Excluding vehicles and gas stations, sales rose 1%. And just remember though, the figures aren't adjusted for inflation. While the increase will look less impressive after taking price movements into account, today's data still suggests that the squeeze on household incomes from inflationary pressures isn't yet having a material impact on discretionary spending, said Andrew Grantham, an economist at Canadian Imperial Bank of Commerce. The data suggests that Americans are still spending on merchandise at a rapid clip, potentially fueled by credit card borrowing, even as prices rise at the fastest pace in decades. That said, economists expect consumer spending to shift away from goods and towards services like travel and entertainment as pandemic-related health concerns wane and demand for summer activities picks up. But the figures adds to signs of an overheated demand that's likely to keep the Federal Reserve on track to raise interest rates by 0.5 percentage point at each of the next two meetings, following a similar increase earlier this month. Some economists fear the Fed will crush demand while trying to tame inflation, which could of course tip the US into a recession. Consumer spending is by far the biggest contributor to the US economy, and it may fall in the coming months due to the end of federal stimulus, rising interest rates, and declining savings. In fact, on Sunday, Goldman Sachs economists cut their forecast for US growth for this year, noting that outlays may slow in response to tighter financial conditions and higher prices. 9 of the 13 retail categories showed growth at last month. While the increase could reflect strong demand for merchandise, the gains could also be a result of higher consumer prices. Since the retail sales aren't adjusted for inflation, real spending data will be released next week, which will be interesting to watch. April retail sales rose solidly and showed no sign that the consumer is cracking under the weight of inflation, higher interest rates, or the lack of stimulus payments, Jeffries said in the note. As a result, Walmart kicked off the wave of quarterly reports from retailers with first quarter results that fell short on the bottom line, pressurized by soaring costs. The supermarket also cut its guidance on second quarter and full year growth, sending its shares more than 11% lower. Ironic, given that retail sales were strong. Home Depot ended up more than 1% after delivering improved guidance following quarterly results that beat on both the top and the bottom lines, underpinned by strong demand. Take-Two Interactive Software reported mixed quarterly results and guidance that fell short of estimates, and that was driven by the impact of the Russian-Ukraine conflict. but this was not a surprise, and the company noted no material change to its long-term projections, Credit Suisse said in the note. So the stock ended up more than 11%. And Citigroup surged more than 7% to lead banking stocks higher after Warren Buffett's Berkshire Hathaway took a $3 billion stake in the bank during the first quarter. JP Morgan, Bank of America, and Wells Fargo were all up more than 3%. Now, Federal Reserve Chair Jerome Powell said on Tuesday that there was broad support among Fed members to raise the Fed's benchmark rate by half a percentage point at the next two meetings to curb inflation. While the Fed can't control the supply issues driving up inflation, the US central bank, quote, has a job to do to reduce demand. There is an imbalance in the economy broadly between demand and supply, Powell said. We can't really affect supply. Our policies don't work on supply issues, but we have a job to do on demand. Restoring the balance in the labour market by curtailing growth will be key to restoring price stability, which Powell described as the bedrock of the economy. I would, for example, point to the labour market, where there's more demand for workers than there are people available to work by a substantial margin. And wages are moving up, which is a great thing, but they're moving up at a pace that is not consistent with 2% inflation, Powell added. Earlier this week, Goldman Sachs said it believes that the current pace of rate hikes priced into the market was enough to restore balance in the labour market as financial conditions continue to tighten. We think that the rate hikes that are currently priced into financial conditions are in the ballpark of what is ultimately needed to restore balance to the labour market and cool wage and price pressures, Goldman Sachs said in the note. We therefore expect that the recent tightening in financial conditions will persist, in part because we think the Fed will deliver on what it is priced. The Fed chief said that the US central bank was prepared to stay the course on rate hikes until it was clear that inflation was abating. We need to see inflation coming down in a convincing way. Until we see that, we will keep going with rate hikes, Powell said, adding that the US central bank wouldn't hesitate to go beyond the neutral rate, the rate that neither slows nor grows the economy, if needed to achieve price stability. Of course, many fear the path to reduced growth, just enough to rein in inflation without tipping the economy into recession, is, well, narrowing, if non-existent. But Powell believes a softish landing remains a possibility, supported by a strong labour market that could, if growth slows, withstand a rise in the unemployment rate. You'd still have quite a strong labour market. If the unemployment rate were to move up a few ticks, there's a number of plausible paths to having a softish landing, Powell said. Achieving price stability is an unconditional need and something we have to do because really the economy doesn't work for workers, for businesses, or anybody without price stability. Now, there was a brilliant political sketch written in The Guardian which really spoke to just how messed up the UK economy really is, and it really became apparent at a meeting of the Treasury Select Committee where Andrew Bailey, the Governor of the Bank of England, Deputy Governor Dave Ramsden, and Michael Sanders and Jonathan Haskell, two economists on the Monetary Policy Committee, were all giving evidence. The committee chair, Mel Stride, got things rolling by asking why the Bank of England had got its inflation forecast so hopelessly wrong and whether it should have taken more action on increasing interest rates to ease the pressure. Now, Bailey is a man who epitomises dullness. Someone not even his close friends and family find it easy to stay awake for. He speaks with the golden voice of a man who chews half a dozen mogadon before he leaves the house in the morning. So for him to sound even slightly panicky is enough to set alarm bells ringing. It was like this, he said. At least 80% of the underlying causes of inflation he had no control over. He could only sit back and let the rise in energy prices and the war in Ukraine do its worst. He was powerless, except the things he could not change. Sir Dave Ramsden, the Deputy Governor, was explicit about the additional financial pain some UK families would face as the Bank of England sought to curb spending and limit price rises by increasing interest rates. If you're remortgaging now, it's going to cost you a lot more than it did a year ago, and that means you will have less to spend on other things, he said. Bank of England officials came under sustained probing by MPs on the failure by the central bank to foresee the big rise in inflation and to take action to tighten monetary policy. It's a very, very difficult place to be, Bailey said. To forecast 10% inflation and to say there isn't a lot we can do about it is an extremely difficult place to be. This is a bad situation to be in. But Bailey deflected criticism by MPs, blaming a series of shocks that he said could not have been forecast. I do see comments based on hindsight, but we have to take monetary policy decisions based on the facts and evidence at the time, he said. Now that, of course, is the Adrian Orr defence from New Zealand. Yes, but Strider was not happy with all of this. He needed more certainty. He needed to know that the Bank of England had a clue what it was doing. And Bailey looked him in the eye before slowly replying, "You could summon all the hindsight you want, but even then you could drag in a couple of punters who knew nothing about economics from the street, and they probably wouldn't do any worse than the MPC." It wasn't just that 80% of the economy was a lawless jungle, far removed from any pathetic monetary levers he might try to use. It was also that he didn't really have much of a clue about the 20% he would normally have some chance of controlling in times of less magical thinking. There was COVID in China. He had no idea how that was going to play out, and he had no idea why so many people had left the labour force. It could be that they had all got long COVID, or it could be that hundreds of thousands had reckoned everything was so crap under the Tories that once lockdown ended, they wouldn't want to go back. Far better to put their feet up and take their chances at home. Might as well die happy. I don't want to panic you, Bailey said, but he clearly did, because he then went on to point out that there would soon be a food crisis. Wheat prices have gone up by 25% in a matter of months. We're all going to starve, and the least we could all do is not to ask for a pay rise. That way, the least well-off could be the first to go. Call it natural selection. And all the more nosh for him, though he was at pains to point out that he too had taken a wage freeze. Somehow he'd struggle on £575,000 a year. Labour's Rashari Ali wondered how the MPC felt about being scapegoated by Liam Fox and other right-wing Tories for not having done much to combat inflation, and Bailey shrugged. He could live with it. If the Tories really wanted to undermine the bank's independence and let the Chancellor have a go, they could be his guest. Though nothing Rishi Sunak had done on the cost of living crisis could have given them any reason to think he had any answers. The man was even more useless than him. The session meandered on for the best part of 2 hours with everyone in a state of denial. No one really wanted to acknowledge just how messed up the economy was, or that no one had a clue about what to do about it. Just hope things would return to normal at some point in the future, and that some of us would be alive to see it. Don't talk about the 80%, or the 20% for that matter. Try to think of a happy place. And Bailey acknowledged the MPC had changed its view about the UK labour market and now believes it is very tight, something it did not understand well until after the government's COVID-19 furlough scheme ended. And he highlighted a large rise in long-term sickness, which has reduced the UK workforce by around 400,000 people. Bailey said no member of the government had raised questions about the Bank of England's independence with him in recent weeks. This is the biggest test of the monetary policy framework for 25 years, he added. This is when both the independence of the bank and the 2% inflation target matter more than ever. Incidentally, most Conservative MPs on the Treasury Committee refrained from attacks on the Governor or the Bank of England. And definitely don't mention Brexit. The Tory MP Kevin Hollinrake tried to get Bailey to quantify the Brexit effect. Bailey really didn't want to engage. He wasn't going to talk about Brexit. It was too difficult to disentangle from COVID. But it might have had some effect. Yes, no, maybe. Well, Ramsden, the Deputy Governor, eventually put Bailey out of his misery. Brexit was going to cause a 3.75% hit to GDP in the long term. But they'd already said that a long time ago, and it was too painful to repeat. There was an embarrassed silence. Ramsden looked around guiltily, as though he'd messed himself. One of the biggest acts of self-harm on even the Bank of England and the Treasury Select Committee could barely bring themselves to mention it. Truly, we are messed up. Now, I love the way that was written, but more importantly, there's a really important message here. Central bankers are really now trying to find any excuse to deflect blame from them. It's convenient, of course, because with supply chain disruptions and COVID and Ukraine, there are external factors. But it's hard to walk away from the real truth, which is that the 20 years plus of loose monetary policy and ultra-low interest rates is what is really coming home to roost now. And frankly, it's surprising to me that central banks are being given such an easy ride. Then again, of course, they are regarded as something like godlike people who have perfect insight, knowledge and experience. Well, I'm afraid I don't agree with that. Central bankers need to justify their existence to me, and so far they have failed miserably. The question I have really to ask is, do we need to change the system? Because are actually central bankers creating the problem and making it worse rather than helping to solve it? That's an interesting debate which I think will rage a bit. But unfortunately, many senior politicians and Treasury officials don't want to go there. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.